Great, thanks. Can everyone hear me okay? Great. Yeah, so I've, in line with exactly that brief, I've pulled together some material. Apologies in advance if it's too detailed. It's really hard to gauge the audience for this stuff, especially as I've been, obviously, like everyone else, in a hole for a year. So just adding to the anxiety of doing this. But yeah, so we're going to be talking about corporate PPAs. We're going to start with looking at the kind of the macro context, and then dive right into the detail of the risks and the structures that corporates can consider. And obviously, Smartest have a role to play, an important role to play, I think, in making this happen in the market. So, yeah, first of all, I should say from Baringa. So Baringa are UK's leading, UK and Europe's really, you could argue, a leading power markets and commercial advisory. We're real deep energy geeks, and you'll probably get that from this presentation. Hopefully we can geek out with some Q&A at the end. So what's the macro context for what we're talking about? So there's growing political support for net zero carbon targets, and this has really been accelerated through COVID. So we're seeing a lot of corporates now, some brands on there in the middle, setting net zero targets quite early on. Particularly interestingly, the water sector actually in the UK, I haven't listed them on here, but they're probably the most aggressive in terms of companies that are large corporates with large energy users really trying to drive the net zero agenda. We're also looking at seeing the tech majors and then some FMCG moving into the space. We have Tesco's, who we've done a significant amount of work with in this space that we're going to talk about. But yeah, so that creates a carbon reduction strategy requirement. There's some regulatory considerations there. So if you're classified as a large business, you need to comply under a regulation called CERC. But basically, if you're a large corporate now, you need to start thinking about and actually delivering your carbon reporting. So what is the carbon intensity of my business? And we do that through these broadly three scopes. There's a fourth, but there's a nuance. So just setting the context of what we're really talking about here when we talk about carbon from a corporate perspective. So I need to report on my scope 1, 2, and 3, and obviously then finally my net position of my carbon intensity. So scope 1 is the emissions produced on site. So what we mean by that really is, I think of it as primary fuels burnt on site. So but diesel oils, gas, any other emissions as well. So it could be NOx. It's measured in carbon equivalent, CO2 equivalent, not CO2. So it includes pretty much everything you emit on site. And then scope 2 is the carbon intensity of what I import into my business. So that's basically power, right? That's power consumption, the carbon intensity of power consumption. There are two ways. It used to be monitored with a locational basis. We've moved to a market-based mechanism. We'll talk about that in a bit. So that enables you to basically offset your scope 2 with REGOs. Okay, we have different views on that in terms of its credibility. We can talk about that. I'm keen to have a discussion on it. And then scope 3 is the carbon emissions of my supply chain. Today, we're going to talk about scope 2, and that's where corporate PPAs come in from a corporate perspective. So how can I contract with renewables, both existing and new assets, in order to reduce my scope 2 footprint? Does that make sense? So what's going on in the renewable sector in the UK? So offshore wind. So offshore wind is, by and large, the primary asset class that's being built out for us to meet our renewable energy targets from a net zero perspective. However, there is significant opportunity for solar PV and onshore wind developers, especially solar PV from the context of corporates. And we'll talk about that in a second in more detail. So please have a look at the info. I won't talk through it in too much detail from a time perspective, but if we think about solar, so as we may know, the government has a floor mechanism, an incentive called the CFD. So AR4, we've got 870 megawatts of solar allowed to bid in and hopefully win, subject to pricing, the CFD, but that leaves circa 1.6 gigawatts our forecast, Baringa forecast of capacity that's going to need what's called a route to market. And that is where the corporate PPA plays a significant role. So there's going to be a significant amount of solar built out in the UK that is going to need a route to market. So someone to buy that power. You could argue that they could just build what's called a merchant-based revenue model where I just put the power into the grid. But because of increasing volatility, developers are more and more less inclined to, you could say at the moment, completely not inclined at all, to build what's called a fully merchant-backed project, especially for solar. And similarly for onshore wind. Battery storage is it's not an asset that you would build specifically for a corporate PPA perspective, but it's an interesting asset class in that you can kind of bundle it in with, for example, solar or wind, especially if you're oversizing that asset for the corporate's energy demand. So it's predominantly onshore solar and wind, and onshore wind. And what are the corporate the revenue streams and routes to market that they have access to? So we have the merchant model as I've discussed, but it can offer value upside, but it lacks the revenue certainty for the developer over the medium and long term. Short term, it can work, but it doesn't really give you the level of revenue de-risking that you're going to need to raise finance for these projects. You've got the traditional PPA, so that offers guaranteed access to power markets. It's traditionally offered alongside government subsidies, ROCs, FITs previously, but now what we're seeing is the corporate PPA. It's an alternative to, obviously we're working in a predominantly subsidy-free environment now, and they have been long-term agreements that are fixed price. Well, the trend is we're now seeing contracts move to more index-linked, CPI index-linked products, shorter tenure, used to be kind of 15, 20 years. We're seeing them move to 10 as developers get more, I see Angus nodding, get more comfortable with the market risk. Okay, making sense so far, I hope. So what are the corporates, from a corporate lens, that was a developer's lens, so from a corporate's lens, what can I do to reduce my scope 2? Okay, so green my power consumption. So I could buy REGOs. So I could buy certificated power from accredited, Ofgem accredited renewable energy. Most corporates do this. You could argue, so I've got kind of a lighter shade of green and a deeper shade of green, that this isn't the greenest option. You're not really supporting additional renewables here. You're basically working within the rules of carbon reporting. You could, if you can, do what's called a private wire PPA. So use your own land or find someone else's land to build a renewables asset, solar, for example, and private wire, so directly connect that into your organization. If you can't do this for geographical constraints or planning constraints, then ultimately you're in this area. So you're either contracting with operational assets or with what we call additional assets, new assets. So either go and find someone that's already got a renewables asset that I can contract with and buy that and offtake that power, or I go and find a developer that wants to do something new, okay? This stuff is what we see the likes of Microsoft doing. So moving, for example, so green flexibility and real-time balancing is basically, I'm going to use my data centers, I'm going to flex the use of my data centers depending on the carbon intensity of the grid within half an hour period. Super advanced, very cool. Okay, so how do you structure a corporate PPA? I'll whiz through this because it's not the most exciting slide, but basically 3 contracts. Okay, so I'm the corporate. I have a supply contract with an energy supplier, Smartest maybe. I then have a traditional PPA, an export PPA, okay, for the export of power. And then I have a corporate PPA with the developer, right? So it's a kind of tri-contract environment. What we've seen so far, we've done a lot of work in this space setting these up, but these have previously been very complex agreements. And as a result of that, only larger corporates have really engaged with this. And there's a space in the market which, you know, Smartest could fill, or someone else, or some other awesome supplier, to make this more commoditized, so standardized, because it's really the blocker for a lot of companies to actually adopt this model. You can look at that, it's like, oh, there's a lot going on. And the other thing that corporates want to try and achieve is what's called additionality. So this is an increasing trend, and I think that's actually being talked about in the next slot. But basically, it's more complicated than you think. Trying to develop truly additional assets, or trying to support truly additional assets as a corporate, is complicated, and it requires you to take on new risks. Yeah, so it's not black and white, even for new build renewable assets. So basically, you need to take on more market risk for a new asset, and this is where the concept of developing a corporate PPA kind of hits the wall of reality, where all of a sudden, as a business, you're exposed to new risks to your balance sheet and P&L that you haven't been before. And the role of the supplier is really important here, because you can help negotiate and sleeve some of these risks through. And also term. So corporates may want to contract longer term to secure this, an improved price point or de-risking because of the risk they're having to put into the project. But actually, developers are now looking to not want to contract as long, because maybe they see an upside market volatility. So won't belabor it, but basically, as a corporate, developing truly additional projects, because you have developers who have an existing portfolio of operational assets and they're looking to build new assets, and they need to subsidize their current portfolio that's coming out of government subsidy and build new stuff, is getting really complicated. Okay, so how do I make money? Really quickly. So as a corporate, this is my power bill. So it's wholesale energy, and then basically the non-commodity aspect. And as we know, energy is only 40% on average of the actual bill. So what a corporate PPA enables you to do is reduce or de-risk, not always reduce, the 55. It doesn't enable you to really have much of an impact on your non-commodity element, because you're still importing power from the grid. Yeah, so I still need to pay all the levies and taxes associated with the import of power, but I can de-risk the wholesale element, or even reduce the wholesale element, all depending upon your view of the counterfactual. So your view of the market is everything on this. This is what you're commercially, what you are hedging, okay? So what I've done here is I put Baringa's view of our reference case. This is our wholesale reference case, yeah? And then we've got our high commodities case, so high gas price, low at the bottom. And what the price range that we're seeing in the market from recent projects that we've been running is within this range. So you could argue, depending upon your view of the market, that a corporate PPA can enable you to actually reduce your wholesale risk and your exposure to volatility. The work that we end up doing here is helping clients to really understand this, really, and the counterfactual. You know, again, I'll say it, the counterfactual is everything. Your view of the do nothing scenario is really important as a corporate, also as an off-taker. So what are we seeing what's the evolution of the market? So as I said before, we're seeing the old world, we're seeing contracts go from circa 15 years to 10. The pricing structures are getting more complicated. So as opposed to where it was just, I'll give you, 45p for 15 years, it's now moving to more of a cap and floor, so 50-50. We're also looking at indexation structures, very complicated ones that annoying people like Baringa come in and set up to make it life harder for the off-taker. And pay as produced as well, where we're seeing that it like really go, actually, and we're moving much more of a fixed volume market for corporate PPAs. So yeah, so hopefully that gives you a high level overview of kind of the economics involved. And then I'm conscious of time, sorry, but just some of the commercial considerations that if I was a corporate and I was looking to do this, these are the 5 broad categories of risk. This is kind of well known within the area, really, but yeah, these are the 5 categories of risk that need to be considered. So commodity risk, which is essentially your exposure to the price of power, volume, so how much you're contracting to buy, shape, so your demand, supply demand, market shape, and then imbalance risk. So that's about your exposure to imbalance costs. So if you're in or out of the money as a result of your corporate PPA, and then obviously the regulatory risks around it. So, you know, risk that a change in regulation reduces market prices or increases costs of trading power, which is completely outside of your control as a corporate. There are ways to mitigate all of these through either the corporate PPA contract or the supply contract. We've worked broadly across all of these multiple times. But essentially what it all comes down to is the individual corporate's view of these risks, whether they're new to them or not. So are there any other kind of precedent commodity risks that they take? That's helpful. So you tend to see corporates that have a large commodity exposure already getting this, right? Because they're already exposed to other commodities in a similar way. Where you're looking at, you know, so an FMCG looking to do this is way more complicated, because all of a sudden I'm having to think about traded markets, index prices. It's brand new to them. So, you know, both as a supplier looking to deliver corporate PPAs, but also as a, you know, an advisor looking at corporates, is who's going to move first. And we're definitely seeing corporates who are used to commodity exposure moving through this. So that's it. It was loads. I'm conscious that was loads of information, but hopefully at least one question.
Oh, I'll come across to you with the mic. Thank you, James.
Great.
Thank you, James. There was a lot regarding direct PPA. So have you seen a sweet spot, break-even point where self-produced asset for additionality, so our own asset, start becoming more palatable for a client than a more complex direct PPA?
Are you saying are private wire PPAs becoming more attractive than corporate PPAs?
Yeah, vice versa, because on the virtual, it's got different benefits.
Yeah, we are. So we're seeing a lot of quite surprising market, you know, corporates in different market segments looking to private wire and self-development increasingly. And it's interesting, actually, you say that, because developers who very much want really to go down the corporate PPA route are being forced increasingly to actually work for the corporate to develop a private wire project. So they're now kind of working as a service provider. You know, I just want you to go and find the land. I want you to get planning, and then I want you to put all the development rights in a genco, and I want to buy that off you for 30 to 100 grand a megawatt, depending on how good they are as a negotiating the private wire, and then the corporate to invest and own that project and outsource the EPC and build it. So that is something that we're seeing more of. You know, personally, I get involved in a lot of those projects as well. Yeah.
Any other questions? Oh, yeah.
Hi. How would you attract the attention of smaller retail customers, where you mentioned the tenor dropped to 10 years, but it's still a long period of time, especially from the budgeting perspective. And most of the retailers in this country, they are not as big as Tesco.
Yeah.
So how would you go about the problem with volume and time?
Yeah, I'll give you my view, which isn't necessarily the Baringa view, but I'll give you my view on that. So it's effectively an aggregation problem, I think. So like you say, you're quite right. You know, it's if I've got large sites and a high frequency of them, you know, massive demand, and also already a massive buying power, like Tesco's is a good example. That's almost a different project entirely. If smaller, if we took at SMEs, what it really requires, I think, is someone to take on a risk position early and accept that risk early through the development cycle, and almost basically contract for, I don't know, 10 megawatts of corporate PPA with a developer or a suite of developers, and then go to the corporates and contract that volume. So basically warehouse the risk before they actually sign the corporate PPA. A supplier can do that. There's complications with that around billing and settlement, general reconciliation of volume. So who pays for what, when, but that is, as long as you have the right tech, that's fixable. But yeah, I think that's the solution. It requires someone to take on, in my opinion, a kind of early risk. It's just whether there's the reward really for doing that. So, I don't know what the commercial model would need to be to warrant the risk exposure that you take on for doing it. And that's a problem that I haven't seen solved in the market yet.